SwayamPrabha. Digital India. Educated India.
Hello friends, welcome to the class of Maritime Law. I am Dr. Ashutosh Acharya, Senior Assistant Professor from Law Center 2, Faculty of Law, University of Delhi. In today's class, that is lecture number 19, we will talk about marine insurance. Now friends, insurance in modern times is an important aspect, be it life, be it any vehicle at land or any other kind of goods. Similarly, in transaction through ships, where ships are also a vehicle that carry goods from one place to another place. So, there are two important subject matters that can be insured, as they can be subjected to or affected by dangers or perils of the sea. They may be affected due to weather conditions, they may be affected due to piracy or any other relevant circumstances or problematic circumstances, wherein we can see that sometimes ships face certain types of hazards, the goods sometimes face certain types of hazards, and when such hazards are faced or when any damage is faced by the ship or by the cargo or by the crew members upon the ship, then in that scenario insurance works as a safety net for all of these subject matters. No transportation is free from peril. Peril can come from any door, any aspect. It may be due to some weather conditions, as I said, or it may be due to collision, accidental or operational problems can come into being, leading to damage to a ship or damage to a cargo. In any of such scenario, if there is an insurance available, the ship owner or the charterer or the cargo owner are mentally free as to they can rely upon the insurance cover that they have taken with respect to the ship, the parts of the ship, which can be hull, which can be machinery of different types, or any other part which can be insured as far as the ship is concerned. The insurance of cargo provides a safety net to the cargo owner, as the cargo owner can be mentally free as to if anything happens to the cargo, then the insurance company will save the cargo owner as far as any kind of financial loss with respect to the cargo is concerned. In that scenario, cargo owner may be the seller or maybe the buyer, depending upon the nature of the contract. So, marine insurance is a very typical specific kind of insurance area, wherein different rules and regulations work as far as marine insurance is concerned as compared to the other kinds of insurance. Well friends, if we talk about India, it was in 1938 that we see Marine Insurance Act came into being in the British India, and certain amendments were made in the 1960s, and we still are governed by that particular act. Similarly, different domestic legal systems have their own marine insurance laws domestically applicable in order to insure ships or the cargo. Now, we must also note where from this particular idea originated, or when was it the first time that this idea got into place as far as marine insurance is concerned. Since ships earlier were so vulnerable as far as their sailing from one part of the world to another part of the world is concerned. Taking into account this vulnerability of the ship as well as the cargo, any marine insurance that could be provided will be very risky, and therefore, looking at the amount of transportation taking place through or from English ports, there was one market known as Lloyd's market, which started with this particular insurance, with this particular kind of insurance known as marine insurance, wherein they could allow for a standard form of contracts to be signed by the insurance companies as well as the owner of the cargo or the ship or the charterer. It was them who initiated the regularization and formalization of marine insurance around the globe. And from that point onwards, we see slowly marine insurance expanded, and it is a booming industry as well at the same time. So, now let us look at a brief introduction or have a brief introduction as far as marine insurance is concerned. What do we actually mean by marine insurance, and what are the different types of marine insurance, what is the procedure of claim, and different miscellaneous aspects pertaining to marine insurance will be discussed in today's class. So, friends, it is a contract of marine insurance is an agreement whereby the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed against transit losses, that is to say losses incidental to transit, which means that the agreement will identify that for what all losses or what all circumstances indemnity will come into being as far as the insured and the insurance company is concerned. A contract of marine insurance may, by its express terms or by usage of trade, be extended so as to protect the insured against losses on inland waters or any land risk which may be incidental to any sea voyage. So, marine insurance is not only limited to the transportation from one port to another port, it can also take into account the whole transaction. So, goods may travel from one particular city which is not a coastal city, and it may travel through truck or through any other vehicle or through train, and then it will reach to a particular coastal estate, it will be unloaded in that coastal district or coastal city, and then it will be delivered to the port, and then from one port A to, if it is delivered to port B, then from port B, if it is to be delivered through road route or rail route or through any other route into some part of the world which is not near to the port. So, this particular transaction is not governed by merely ship, or the transportation is not only taking place through ship, through sea route, but is also taking place through, may take place through inland waters, road route, rail route, air route within the domestic scenario. Marine insurance can cover point to point transaction, that is, it may not necessarily only take into account that the insurance will start from the point when the goods are loaded at port, and it will end when it reaches or is unloaded to port B. It can continue to exist even for the transaction which is not through sea route. So, it can be from point to point transaction also. So, the expansion of marine insurance is larger, and it is not restricted to only sea transport. Therefore, we can say that marine insurance includes different types of insurances also. Apart from the scope of marine insurance, we need to look at the subject matter of insurance as well. As I told you, largely there are two subject matters, cargo and also the ship. Now, when we talk about ship can have different types of insurance policies. It can insure the hull, it can insure the machines or the engines or other parts of the ship, depending upon the construction of the ship and depending upon the contractual agreement between the ship owner and the insurer. So, therefore, marine insurance includes cargo insurance, which provides insurance cover in respect of loss of or damage to goods during transit by rail, road, sea or air. Thus, cargo insurance concerns the following: export and import shipments by ocean going vessels of all types. It can also include coastal shipments by steamers, sailing vessels, mechanized boats, etc. A cargo insurance can also concern shipments by inland vessels or country craft, and consignments by rail, road or air, and articles sent by post. Secondly, marine insurance can also include hull insurance, which is concerned with the insurance of ships, hull, machinery, etc. This is a highly technical subject and is not dealt in, will not be dealt in this particular module. But friends, let me give you a general idea as to what do we mean by the hull. So, when we look at the construction of the ship, let us say this is the outer area of the ship, that is the keel of the or the base of the ship, and the hull will be positioned inside this particular area, which will be below the free deck area. Now, if this is the hull, it will consist of various parts wherein machines will be located, or any other important aspects through which ship is run or through which ship can be used to sail. Now, different machineries and engines existing inside the hull of the ship, we can say if it is insured, then everything present within the hull gets also insured and can be insured. Now, there are different features of marine insurance. Now, just like a contractual agreement, marine insurance is also a contractual agreement, and it has also its very specific features. And due to those specific features, due to the nature of the peculiar type of contract, when can we say that marine insurance has begun, or when did the contract can be considered to have been started, and when can we say that it has come to an end. So, let us look at the different features of marine insurance. The first one being offer and acceptance. It is a prerequisite to any contract. Similarly, the goods under marine, that is transit insurance, will be insured after the offer is accepted by the insurance company. For example, a proposal submitted to the insurance company along with premium on 1st of April 2024, but the insurance company accepted the proposal on 15th of April 2024. The risk is covered from 15th of April 2024, and any loss prior to this date will not be covered under marine insurance. So, just like any other contract, marine insurance contract also requires offer and acceptance, and the contract comes into force only after the offer is accepted. Secondly, the second feature would be payment of premium. An owner must ensure that the premium is paid well in advance, so that the risk can be covered. If the payment is made through check and it is dishonored, then the coverage of risk will not exist. It is as per section 64 VB of Insurance Act 1938, payment of premium should be in advance. Thirdly, contract of indemnity. So, what type of contract is marine insurance? It is a kind of contract of indemnity, where indemnification happens in case any loss takes place. So, it is a condition based contract between the insurer and the insured, that only if damage takes place, the contract of insurance will come into being and the compensation or the indemnification will be undertaken. Marine insurance is a contract of indemnity, and the insurance company is liable only to the extent of actual loss suffered. If there is no loss, there is no liability. Even if there is operation of insured peril, for example, if the property under marine insurance which is in transit, that is the property if it is in transit, then the marine insurance is insured for rupees 20 lakhs, and during transit it is damaged to the extent of rupees 10 lakhs, then the insurance company will not pay more than rupees 10 lakh. So, it is damage dependent type of contract, as we say it is a contract of indemnity. Fourthly, one of the most important feature of the marine insurance is, or marine insurance contract is based upon uberema facie, which means that the relationship between the insured and the insurer must be based upon utmost good faith, and it says that the owner of goods to be transported must disclose all the relevant information to the insurance company while insuring their goods. The marine policy shall be voidable at the option of the insurer in the event of misrepresentation, misdescription or non-disclosure of any material information. Now, for example, the nature of goods must be disclosed, that is, whether the goods are hazardous in nature or not, as premium rate will be higher for hazardous goods. Similarly, we can take the example of a ship. If there is any defect inside the ship, and if the machinery is insured and wrong or information has been provided to the insurer, or any misrepresentation with respect to the hull of the ship is provided to the insurer, then in that case or in that particular scenario, the contract will be voidable at the option of the insurer. Further, another feature of marine insurance is insurable interest. Any person who is entitled to claim the amount or the indemnification against the insurer must have an insurable interest. unless and until the person has an insurable interest in the property, or we can say that any particular kind of interest resides in the cargo or any particular kind of interest resides in the ship, then only the indemnification can be claimed against the insurer. So, this is another feature that we see as far as marine insurance is concerned, that is insurable interest. It says the marine insurance will be valid if the person is having insurable interest at the time of loss. The insurable interest will depend upon the nature of sales contract. Example, Mr. A sends the goods to Mr. B on FOB, that is free on board basis. Now, free on board basis contract means it is a contract between the seller and the buyer, and if it is a FOB contract, that means the title of the goods have been transferred to the buyer, and since the ownership, or you can say the title, has been transferred upon to the buyer, the liability will be that of the buyer. In that scenario, if the buyer who has not seen the goods so far and they are loaded by the seller and in some other port, in that scenario the buyer can insure the goods, and since it is the insurable interest of the buyer into those goods that he has not seen or she has not seen so far getting loaded onto some other port, in that scenario insurable interest of the buyer will be levied. So, especially in cases where there is FOB contracts, if let us say Mr. A sends the goods to Mr. B on FOB basis, which means the insurance is to be arranged by Mr. B, since Mr. B is the buyer, and if any loss arises during transit, then Mr. B is entitled to get the compensation from the insurance company. For example, Mr. A sends the goods to Mr. B on CIF basis, that is cost, insurance and freight. This particular type of CIF contract is entered into when the title or the ownership is not transferred to the buyer, but is still residing with the seller. So, in general parlance, if the seller is still the owner, the seller will take the insurance. So, therefore, if it is a CIF basis contract between the seller and the buyer, which means the insurance is to be arranged by Mr. A, since A is the seller, and if any loss arises during transit, then Mr. A is entitled to get the compensation from the insurance company. Sixth feature of marine insurance is contribution. If a person insures his goods with two insurance companies, then in case of marine loss, both the insurance companies will pay the loss to the owner proportionately. For example, goods worth rupees 50 lakhs were insured for marine insurance with insurance company A and insurance company B. In case of loss, both the insurance companies will contribute equally. So, when we say proportionately, if the insurance of the goods is up to the value up to the 60% or 70% of the value, the insurance amount is higher, the premium is higher with one company, whereas the premium is lower with any other company. So, proportionately it will be adjusted, not always that it will be adjusted 50-50. Further feature of marine insurance is period of marine insurance. The period of insurance in the policy is for the normal time taken for a particular transit. Generally, the period of open marine insurance will not exceed 1 year. It can also be issued for the single transit and for a specific period, but not for more than a year. So, we see that generally if the insurance is undertaken as far as the period of insurance is concerned, it will be 1 year. But we also see that different types of transactions takes place. So, the insurance could be for one particular voyage. So, if let us say the charterer has chartered the ship for one particular voyage or certain particular voyages, then the charterer would go for certain specific voyages that he or she has undertaken or it has undertaken. The insurance will be for those particular voyages. Apart from that, if it is pertaining to the goods, then one particular voyage, or if it is with respect to certain period of time, then the time specific insurance can also come into being, but generally it will be for a year. Then another feature of marine insurance is deliberate act. If goods are damaged or loss occurs during transit because of deliberate act of an owner, then that damage or loss will not be covered under the policy. Lastly, claims. To get the compensation under marine insurance, the owner must inform the insurance company immediately so that the insurance company can take necessary steps to determine the loss. What if the claim is not made immediately and after a certain period of time. So, if there is a time lapse, what will happen? It will raise certain doubts as to the truthfulness of the claim or as to the value of the claim as far as the claim made by the insured against the insurer is concerned. So, the basic one of the important basic feature is that if the claim is to be made, it must be made as soon as possible. The insured must be informed immediately of the damage that has occurred as far as the cargo is concerned or as far as the ship is concerned. Further, operation of marine insurance. Marine insurance plays an important role in domestic trade as well as international trade. Most contracts of sale require that the goods must be covered either by the seller or the buyer against loss or damage, who is responsible for effecting insurance on the goods which are the subject of sale. It depends on the terms of the sale contract. A contract of sale involves mainly a seller and a buyer, apart from other associated parties like carriers, banks, clearing agents, etc. The principal types of sale contracts so far as marine insurance is directly concerned are as follows. It may be a free on board contract where the seller is responsible till the goods are placed on board the steamer, the buyer is responsible thereafter. He can get the insurance done wherever he likes. Free on rail contract, FOR contract, the provisions are the same as in above. This is mainly relevant to internal transactions. That is again will depend upon the relationship between the seller and the buyer, whether it is a CIF kind of contract or FOB kind of contract, even if it is taking place internally, also the same law and logic will be applicable. Cost and freight contract. Here also the buyer's responsibility normally attaches once the goods are placed on board. He has to take care of the insurance from that point onwards. Cost, insurance and freight, that is CIF contract. In this case, the seller is responsible for arranging the insurance up to destination. He includes the premium charge as part of the cost of goods in the sale invoice. Contract of marine insurance. Most of the law of marine insurance is in essence pure interpretation of the contract contained in the common form of marine policy. The basic principle of a contract of insurance is that the indemnity recoverable from the insurer is the pecuniary loss suffered by the assured under the contract. Thus, as per the enactment, a contract of marine insurance is a contract whereby the insurer undertakes to indemnify the assured in a manner and to the extent thereby agreed against marine losses, that is to say, the losses incident to marine adventure. A contract of marine insurance may by its express terms or by usage of trade be extended so as to protect the assured against losses on inland waters or any land risk that may be incidental to any sea voyage that we have already discussed and understood. Where a ship in course of building or the launch of a ship or any adventure analogous to a marine adventure is covered by a policy in the form of marine policy, the provisions of this act in so far as applicable shall apply thereto, but except as by this section provided, nothing in this act shall alter or affect any rule of law applicable to any contract of insurance other than a contract of marine insurance as defined by the Marine Insurance Act. The formal instrument embedding the contract of marine insurance is called the policy and the slip or covering note, is the informal memorandum that is drawn up when the contract is entered into. The subject matter insured and the consideration for the insurance are respectively known as the interest insured and the premium. The person who is indemnified is the assured and the other party is styled the insurer or the underwriter, so called because he subscribes or underwrites the policy. Loss includes damage or detriment as well as actual loss of property arising from maritime perils, and when we say maritime peril, we mean to say maritime dangers. Now, dangers could be of number of nature, different types of dangers can be present, as I told you, whether is one of the kind of danger, another kind of danger could be collision or tough routes or piracy or any other kind of mishap that can come into being. So, as we see that maritime perils means the perils consequent on or incidental to. So, I repeat, maritime perils means the perils consequent on or incidental to the navigation of the sea. That is to say, perils of the sea, fire, war perils, pirates, rovers, thieves, captures, seizures, restraints and detainments of princes and peoples, jettisons, barratry and any other perils either of the like kind or which may be designated by the policy. The phrase perils of the sea refers to dangers that are particularly incident to the sea or navigation thereof. It refers only to fortuitous accidents or casualties of the sea or caused by the sea. It was not necessary that there must have been strong winds or waves at the time of the accident to constitute peril of the seas. There must be some casualty, something that could not be foreseen as one of the necessary accidents of adventure. A marine adventure includes any adventure where any insurable property, that is to say any ship, goods or other movables, is exposed to maritime perils. Secondly, the earning or acquisition of any freight, passage, money, commission, profit or other pecuniary benefit or the security for any loss, advance, loan or disbursement is endangered by the exposure of insurable property to maritime perils. So, we look at the understanding of the word maritime peril and maritime adventure is quite expansive in order to include the different kinds of perils and different kinds of adventures and also maritime loss at the same time. Even the freight and the profit that could have earned can also be considered as a relevant factor as far as the maritime loss is concerned. Further, any liability to a third party may be incurred by the owner of or other person interested in or responsible for insurable property by reason of maritime perils. Now, what do we mean by insurable interest? So, as I told you that in order to bring a claim as far as the insurance is concerned, the person who is claiming must have an insurable interest, that is interest in the concerned property that had faced damage due to any maritime peril while within the maritime adventure. Marine Insurance Act declares void all marine insurance policies where insurable interest does not apply at time of loss. In the Act, insurable interest is defined as subject to the provisions of this Act. Every person has an insurable interest who is interested in marine adventure. In particular, a person is interested in a marine adventure where he stands in any legal or equitable relation to the adventure or to any insurable property at risk therein, in consequence of which he may benefit by the safety or due arrival of insurable property or may be prejudiced by its loss or damage thereto, or by the detention thereof, or may incur liability in respect thereof. The essence of interest is that there should be a physical object exposed to sea perils, and the assured should stand in some relationship recognized by law to that object, in consequence of which he either benefits by its preservation or is prejudiced by its loss or mishap thereto. The insured must bear some relationship to the insured thing, whereby she stands to benefit by its safety or be prejudiced by its loss or by incurring liability. That is to say, insurable interest exists where insured stands in a legal relationship to the property or otherwise stands to suffer loss as a result of its destruction. So, the person who claims to have an insurable interest must be able to establish legal relationship between himself or herself and the property concerned. Attachment of interest. Section 8 of the Indian Act of 1963 states in the following words when interest must attach. The assured must be interested in the subject matter insured at the time of the loss, though he need not be interested when the insurance is affected, provided that where the subject matter is insured, lost or not lost, the assured may recover although he may not have acquired his interest until after the loss, unless at the time of effecting the contract of insurance, the assured was aware of the loss and the insurer was not. Where the assured has no interest at the time of the loss, he cannot acquire interest by any act or election after he is aware of the loss. The main problem with insurable interest concerns the time at which the interest must attach. As a general rule, as given under section 8 above, the assured must at the time of loss have an insurable interest in the subject matter insured. In contracts of international sale of goods, it is not always easy to ascertain at any given time whether the property has in fact passed from seller to buyer. The existence of interest is a condition to effective insurance. It is often a difficult question to determine the exact moment when under a contract of sale the risk passes from seller to buyer. Prima facie, the risk passes when the property passes, but under the terms of the contract they may pass at different times. So, the parties can also agree as to the when the risk will pass or when the risk will not pass. When the buyer insures goods, the question is whether on the true construction of contract the risk has passed to him at the time the loss occurs. Thus, the law recognizes certain exceptions to the general rule that the assured must have an insurable interest at the time of the loss. Now, let us consider a situation that goods are transported from country A to country B, and while multiple goods are being transferred, the owner of the goods is still in country A, and while the goods are in transit, the goods have been sold to person X or person Y or person Z by a person who is the real owner situated in country A. Now, as the goods got transferred while the goods were en route to country B, when did the goods transfer? At that particular point, if the goods are insured and if any loss happens to those goods, who will have the insurable interest in the goods? Now, this will be decided on the fact and circumstances of the case, that when the goods were transferred or after the goods were transferred, did they face the loss after they were transferred in the name of XYZ, or did they face the loss prior to the incident that the goods are getting transferred to X, Y or Z. So, if they were transferred prior to the transfer or any loss happened prior to the transfer, then the insurable interest will be that of the person situated in country A. But if the loss has taken place after the transfer has taken place, then the insurable interest will not be that of person situated in country A, but the person or persons situated in country B, that is X, Y, Z. So, this is how the insurable interest has to be identified. In different circumstances, the insurable interest could be shifting or could have passed upon, also depending upon sometimes and many a times we see depending upon the ownership or the title of the goods. First, if the policy offers cover on a lost or not lost basis, then the assured is, according to the proviso to section 8 clause 1, permitted to recover under the policy even though the loss was sustained before the insurance was effected. This exception operates to protect an assured who might have purchased goods without knowing whether or not they have already been lost at sea. Secondly, an assignee of a policy can acquire an interest in the subject matter insured even though the policy was assigned to him only after the loss, provided of course that the assigner himself had at the time of assignment an interest to assign. Moreover, a defeasible or contingent interest as per section 9, partial interest under section 10, bottomry under section 12, masters and seamen's wages section 13, advance freight under section 14 and charges of interest are all cases of insurable interest. With reference to assignment of interest, section 17 of the Indian Act provides, where the assured assigns or otherwise parts with his interest in the subject matter insured, he does not thereby transfer to the assignee his rights under the contract of insurance. unless there be an express or implied agreement with the assignee to that effect. But the provisions of this section do not affect a transmission of interest by operation of law. Where a cargo of tallow was insured warehouse to warehouse by purchasers, and the cargo was delivered short for transit, and the missing quantity was never in transit and never became the property of the purchasers. They were held to have no insurable interest, and the underwriters were held not liable for the missing quantity. Valuation of insurance. The insurance value of the subject matter insured is relevant in determining the measure of indemnity in the case of an unvalued policy. If the policy is valued, then the cases are simple, or the scenario is quite simple. The amount is identified, but where the amount is not identified, the policy is unvalued, then how do you value the amount to be indemnified? So, in the case of a valued policy, when the valuation is not conclusive or has to be apportioned, a clear delimitation of insurable value is necessary. To fix the measure of indemnity in the case of an unvalued policy, then to fix the measure of indemnity in the few cases in which a valued policy can be opened up, and to furnish an approximate standard for fixing the value in a valued policy. According to modern practice, unvalued policies are very rare, being practically confined to goods and in a few instances to freights payable on arrival. Other interests are almost invariably insured by valued policy. As regards goods, a voyage policy on goods is an insurance of the adventure as well as an insurance on the goods themselves. Practice in international trade with respect to the valuation. The normal practice in export-import trade is for the exporter to ask the importer to open a letter of credit with a bank in favor of the exporter. As and when the goods are ready for shipment by the exporter, he hands over the documents of title to the bank and gets the bill of exchange drawn by him on the importer, discounted with the bank. In this process, the goods which are the subject of the sale are considered by the bank as physical security against the monies advanced by it to the exporter. A further security by way of an insurance policy is also required by the bank to protect its interests. So, a merely drawing of letter of credit and submission of the documents related to the goods will not suffice. So, the modern practice, international practice is to also undertake that whether the goods are insured or not. So, insurance policy documents are also kept with the bank, so that if any loss happens to the goods, then the transaction automatically will be nullified as far as the exporter and importer are concerned. But the bank who has lent the money on behalf of the importer will not be at loss, since the insurance, since the goods are insured and indemnification can come into place. So, a further security by way of an insurance policy is also required by the bank to protect its interests in the event of the goods suffering loss or damage in transit, in which case the importer may not make the payment. The terms and conditions of insurance are specified in the letter of credit. For export-import policies, the Institute Cargo Clauses, that is ICC, are used. These clauses are drafted by the Institute of London underwriters and are used by insurance companies in a major of the countries including India, since, as I told you in the beginning itself, the London market, the Lloyd's market is considered to be a standard market, and it delivers standard forms for different types of contracts. So, the underwriters in England provide for standard form of agreements to the parties. Procedure to insure under marine insurance. Now, what is the procedure in order to obtain the insurance? Submit a form, quotation from the insurance company will be available, then payment of premium will be done, and then issue of cover note or policy will be done by the insurance company. Now, as far as the submission of form is concerned, the form will have the following information: the name of the shipper or consignor, that is the insured, full description of goods to be insured, The nature of the commodity to be insured is important for rating and underwriting. Now, the goods whether are of perishable nature or of non-perishable nature, whether the goods are to be kept in a particular temperature or are to be kept in a particular environment, every detail must be mentioned as far as the mentioning of facts about the goods are concerned. Different types of commodities are susceptible for different types of damage during transit. Sugar, cement, etc. are easily damaged by seawater. Cotton is liable to catch fire. Liquid cargoes are susceptible to the risk of leakage and crockery. Glassware to breakage, electronic items are exposed to the risk of theft and so on. Method and type of packing. The possibility of loss or damage depends on this factor. Generally, goods are packed in bales or bags, cases or bundles, crates, drums or barrels, loose packing, paper or cardboard cartons or in bulk, etc. Voyage and mode of transit. Information will be required on the following points. So, apart from the packing, the nature of the goods, what is the mode, what is the voyage, the route, etc. So, when we say all the details are to be provided, these are the minute details that are to be provided as far as the goods are concerned. So, with respect to voyage and mode of transit, information will be required on the following points. The name of the place from where transit will commence and the name of the place where it is to terminate. Mode of conveyance to be used in transporting goods, whether by rail, lorry, air, etc. So, all of the details, not only the detail of the port to port, but also the other mode of transportations that will be undertaken and utilized in order to transport the goods must also be mentioned. So, whether by rail, lorry, air, etc. or a combination of two or more of these, the name of the vessel is to be given when an overseas voyage is involved. In land transit by rail, lorry or air, the number of the consignment note and the date thereof should be furnished. The postal receipt number and the date thereof is required in case of goods sent by registered post. If a voyage is likely to involve a transshipment, it enhances the risk. This fact should be informed while seeking insurance. Transshipment means the change of carrier during the voyage. So, while the voyage is undertaken, if from one ship to another ship the goods are to be transferred, it involves another kind of risk and this information must be supplied to the insuring company. Risk cover required. The risk against which insurance cover is required should be stated, whether you require the risk to be, what all types of risks are to be covered as far as the insured subject matter of the insurance is concerned, whether with respect to weather, whether with respect to piracy or any other subject matter that needs to be covered must be mentioned. Quotation by insurance company based on the information provided as above, the insurance company will quote the premium rate. In nutshell, the rates of premium depends upon nature of commodity, whether the commodity is of higher risk. If there is a higher risk as far as the commodity is concerned, then higher insurance premium will be demanded by the insurance company. If the product or the goods is lesser in risk as far as its damage, etc. is concerned, or let us say the voyage or the route that the ship is going to take is a safer route as compared to other routes. If the route is comparatively less safer route, let us say it has to cross through certain waters where there is high percentage of piracy or pirate activities are quite pirates are quite active in that particular region, then in such a scenario the insurance company will raise its premium as it is taking the higher risk with respect to the voyage or with respect to the goods. So, in nutshell, the rates of the premium depends on the nature of commodity, method of packing, the vessel, type of insurance policy. Let us say the vessel is old, so in those cases the insurance premium will be higher and lesser coverage will be provided or may be provided. If the vessel is comparatively new, then the premium would comparatively be less as the risk is less as compared to the older vessels. And the type of insurance policy also is the factor which will decide upon the premium. Now, payment of premium. On accepting the premium rates, the concerned person will make the payment to the insurance company. The payment can be made on the consignment basis. D. Issue of cover note or policy document. So, if the policy document is to be issued, it can be issued in different types of forms. Now, the different types of forms could be cover note, marine policy, open policy. What is a cover note? A cover note is a document granting cover provisionally pending the issue of a regular policy. It happens frequently that all the details required for the purpose of issuing a policy are not available. For instance, the name of the steamer, the number and date of the railway receipt, the number of packages involved in transit, etc. may not be known. Second is marine policy. This is a document which is in evidence of the contract of marine insurance. It contains the individual details such as name of insured, details of goods, etc. These have been identified earlier. The policy makes specific reference to the risks covered. A policy covering a single shipment or consignment is known as a specific policy. Third is open policy. An open policy is also known as floating policy. It is worded in general terms and is issued to take care of all shipments coming within its scope. It is issued for a substantial amount to cover shipments or sending during a particular period of time. Declarations are made under the open policy and these go to reduce the sum insured. Open policies are normally issued for a year. If they are fully declared before that time, a fresh policy may be issued or an endorsement placed on the original policy for the additional amount. On the other hand, if the policy has run its normal period and is cancelled, a proportionate premium on the unutilized balance is refunded to the insured if full premium had been earlier collected. On receipt of each declaration, a separate certificate of insurance is issued. An open policy is a stamped document and therefore, certificates of insurance issued thereunder need not be stamped. Open policies are generally issued to cover inland consignments. There are certain advantages of an open policy compared to specific policies. These are automatic and continuous insurance protection, clerical labor is considerably reduced, some saving in stamp duty. This may be substantial, particularly in the case of inland sendings. Open cover. An open cover is particularly useful for large export and import firms making numerous regular shipments who would otherwise find it very inconvenient to obtain insurance cover separately for each and every shipment. It is also possible that through an oversight on the part of the insured, a particular shipment may remain uncovered and should a loss arises in respect of such shipment, it would fall on the insured themselves to be borne by them. In order to overcome such disadvantage, a permanent form of insurance protection by means of an open cover is taken by big firms having regular shipments. An open cover describes the cargo, voyage and cover in general terms and takes care automatically of all shipments which fall within its scope. It is usually issued for a period of 12 months and is renewable annually. It is subject to cancellation on either side, that is the insurer or the insured by giving due notice. Since no stamps are affixed to the open cover, specific policies or certificates of insurance are issued against the declaration and they are required to be stamped according to the Stamp Act. There is no limit to the total number or value of shipments that can be declared under the open cover. Following are the important features of an open policy or open cover. Limit per bottom or per conveyance. The limit per bottom means that the value of a single shipment declared under the open cover should not exceed the stipulated amount. Basis of valuation. The basis normally adopted is the prime cost of the goods, freight and other charges incidental to shipment. Cost of insurance plus 10% to cover profits. The percentage to cover profits may be sometimes higher by prior agreement with the clients. Location clause. While the limit per bottom mentioned under A above is helpful in restricting the commitment of insurers on any one vessel, it may happen in actual practice that a number of different shipments falling under the scope of the open cover may accumulate at the port of shipment. The location clause limits the liability of the insurers at any one time or place before shipment. Generally, this is the same limit as the limit per bottom or conveyance specified in the cover, but sometimes it may be agreed at an amount say up to 200% thereof. Rate A schedule of the agreed rates is attached to each open cover. Terms: there may be different terms applying to different commodities covered under the open cover, and they are clearly stipulated. Declaration clause: the insured is made responsible to declare each and every shipment coming within the scope of the open cover. An unscrupulous insured may omit a few declarations to save premium, especially when he knows that shipment has arrived safely. Hence the clause. Cancellation clause: this clause provides for cancellation of the contract with a certain period of notice, example, a month's notice on either side. In case of war and SRCC risk, the period of notice is much shorter. A distinction between open policy and open cover. The open policy differs from an open cover in certain important respects, and they are that the open policy is a stamped document and is therefore legally enforceable in itself, whereas an open cover is unstamped and has no legal validity unless backed by a stamped policy or certificate of insurance. An open policy is issued for a fixed sum insured, whereas there is no such limit of amount under any open cover. As and when shipments are made under the open policy, they have to be declared to the insurers, and the sum insured under the open policy reduces by the amount of such declarations. When the total of the declarations amounts to the sum insured under the open policy stands exhausted and has to be replaced by a fresh one. Certificate of insurance. A certificate of insurance is issued to satisfy the requirements of the insured or the banks in respect of each declaration made under an open cover or open policy. The certificate which is substituted for a specific policy is a simple document containing particulars of the shipment or sending. The number of open contract under which it is issued is mentioned, and occasionally terms and conditions of the original cover are also mentioned. Certificates need not be stamped when the original policy has been duly stamped. Types of marine insurance: special declaration policy, special storage risk insurance or annual policy, duty insurance, increased value insurance are some of the types of marine insurance policy. This is special declaration policy is a form of floating policy issued to clients whose annual estimated dispatches, that is turnover by rail, road, inland water, exceeds rupees 2 crore. Declaration of dispatches shall be made at periodical intervals and premium is adjusted on expiry of the policy based on the total declared amount. When the policy is issued, sum insured should be based on previous year's turnover or in case of fresh proposals on a fair estimate of annual dispatches. A discount in the rates of premium based on turnover amount, example exceeding rupees 5 crores etc., on a slab basis and loss ratio is applicable. Special storage risk insurance. This insurance is granted in conjunction with an open policy or a special declaration policy. The purpose of this policy is to cover goods lying at the railway premises or carriers' godowns after termination of transit cover under open. In regard to claims relating to this type of transit, the documents required to be submitted to the insurance in support of the claim would be similar to what we have discussed. In addition, we will have a special power of attorney duly stamped in railways claims, letter of authority addressed to the railway authorities, letter of authority addressed to the railway authorities signed by the consignor in favor of the consignee and consignors in favor of the insurance. Claim bill should also be attached. Then risk coverage and exclusions are also an important aspect. As far as the exclusions are concerned, we must note that loss caused by willful misconduct of the insured, ordinary leakage, ordinary loss or loss caused by inherent vice, loss caused by delay or deliberate damage will lead to exemption of the insurance company, or loss arising from insolvency, or loss or damage due to inadequate packing, war, kindred perils, strikes, riots, all of which can allow the exemption of the insurance company. Now, let us look at the different types of factors that affect as far as the marine insurance is concerned. Now, there are certain miscellaneous aspects that must be undertaken. One of the most important miscellaneous aspects that must be discussed is with respect to the situation where total loss has happened or where a certain part of loss has happened. As far as total loss is concerned, the goods may be totally lost by the operation of the marine peril. The measure of indemnity in the event of total loss of the goods is full insured value. The insurers are entitled to take over the salvage, if any. An actual total loss takes place where the subject matter is entirely destroyed or damaged to such an extent that it is no longer a thing of kind insured. As against actual total loss, a constructive total loss, which is a commercial total loss, takes place where the subject matter insured is abandoned on account of the actual total loss being inevitable. Another type of feature is with respect to particular average as far as partial losses are concerned. So, where there are partial losses caused by marine perils, the particular average losses occurs when there is a total loss of the part of the goods covered. A consignment may consist of 100 packages, out of which 5 packages may be lost completely. Another way in which particular average loss occurs is when there is damage to the goods. Where whole or any part of the goods insured is delivered damaged at the destination, the percentage of depreciation is ascertained by a surveyor appointed for the purpose, by comparing on the one hand the gross sound market value and on the other hand the gross damaged market value on arrival of the goods at destination. General average, it is a loss caused by General Average Act. An act is referred to as General Average Act when an extraordinary sacrifice or expenditure is made to save the entire ship, which may include towage, salvage activities in order to save the property, and when this is done, or such as cargoes are jettisoned, when such kind of extra efforts are taken in order to save the property, in order to bring the property to its destination, extra expenses are made, then general average comes into being in order to calculate the insurance amount in favor of the assured by the insurance company. And there are other types of charges that can be added. There are different kinds of miscellaneous scenarios that can lead to calculation of the insured amount, that is the indemnified amount in favor of the assured person by the insurance company, which may be relating to salvage loss, sue and labor charges, extra charges, recovery from carriers, etc. Now, with this we have taken an overview as far as the marine insurance is concerned, and I thank you for your patient listening. Namaskar.